get to Jeff Halley, Senior Manager, FX Trading at Saxo Capital Markets, joining us live here on set together with our guest host, Jim Rogers. Jeff, good to see you, and good morning. Let's get this out of the way. ECB, BOE, both are going to cut, but any surprises expected?
I think the only surprise would be if the Bank of England didn't cut today and decided that they were going to adopt a wait-and-see attitude. But we're calling for both the ECB and the Bank of England to both go ahead.
And both down 50, yeah?
Yep.
Okay, what about quantitative easing, though, from BOE?
That'll be the devil is in the detail here again. We're expecting them to get the go-ahead to commence QE this week. Yeah. It's a matter of what they're actually going to use that money for.
But Jeff, if they do that, what's going to happen to the currencies? I mean, I consider that a negative.
I do too. We've been very bearish on sterling for the last year, and we're still expecting sterling to probably trade down to low 1.2 against the US dollar.
Jim, you're looking for below 1 to 1.
Well, I just think it's, 1 to 1, but not this week. not this quarter, maybe not even this year. Yeah, right. Not by the end of the day. No, I'm extremely bearish on sterling for the next few years. Now they're in trouble, in serious trouble. But I would suspect that the euro too, if they cut that much, it would be bad for the euro for a while.
Yeah, we're expecting the euro to head much lower over the course of the year as well. Simply, but mainly because we're expecting the risk with all the debt that the Western European banks own in Eastern Europe to start to play big time later on in the year. So we feel that overall that will weigh very heavily on the euro.
Okay, Jeff, just very quickly, if I can step in here, Jim, staying with the euro, how concerned are you about this risk of contagion from the developing, emerging Eastern European economies and the impact that's going to have on the eurozone, then by implication the euro, because that's been flagged as a key negative for the single currency?
To us it's a major issue, and I don't want to sound like a rider of the apocalypse here, but the actual sheer amount of debt that the Eastern European economies are carrying, mainly in foreign denominated currencies as well, which is the real crux of the whole problem. They owe money in euros and Swiss francs, or the dual currency loan structures, and most of that is owned by European banks, not by US banks, by European banks, and we feel that's a significant problem going forward.
Jeff, I am looking for a sound currency. I want to get out of all of my dollars sometimes this year, and I am having a great deal of trouble finding the, or even a, sound currency for the next decade. Who is it? Where is it?
To be honest, I know we were talking off camera before. I think actually the US dollar will be strong for the remainder of this year, and then into 2010. We feel that maybe the Australian dollar, even Kiwi, the commodity currencies can start to make a comeback from there.
But better than the Canadian dollar?
Canadian dollar, I find a very difficult one to trade at the best of times anyway. It's called the loonie, and that's a very good reason for that one, frankly. So many extraneous things going on in the Canadian dollar, and it's also intrinsically tied to the US, United States economy's fortune. So we prefer a less crowded part of the world with less
Jeff,
noise.
What are you predicating that bounce back, if I heard you correctly, in 2010 in the Aussie dollar and the Kiwi? Is that predicated on recovering commodities?
Yeah, I mean, we're feeling that the Aussie and the Kiwi are going to make new lows this year. Probably down towards 0.4 for the Kiwi against the dollar, down to 0.5 for the Aussie. Let's not argue over big figures as how far it goes, but we feel that from that time on, the values are exceedingly good in those two currencies.
Is there something we miss, like the Brazilian currencies or Malaysia or who knows what?
Well, Malaysia has a fixed currency regime, but an emerging market is a market that I've always thought that you can't emerge from in an emergency. And although I feel that going forward that Brazil has a tremendous future, it's not actually the place where I would park my money, so to speak, simply because if you need to get out, you need a liquid developed market to do so.
Yeah. So there's
nowhere to hide this year, Jim.
But Jim, you were long yen, right? You like yen?
No, I own the yen. I mean, it's not doing me any good these days for the last 2 or 3 weeks. But no, I expect. Do you think that the Japanese will give incentives to bring the yen back, all that offshore yen, because they got to do something?
They already are giving tax incentives, are they not?
They
Plus,
are.
We've got year-end coming up. Repatriation?
I think we've actually seen a lot of this repatriation already, but even if they do give incentives to repatriate their offshore earnings, as they did in the United States a few years ago, I really don't feel that will be the flows there will offset the actual economic fundamentals of Japan, unfortunately, for the next few years.
But when they did it in the U.S., which had horrible fundamentals, it did cause a rally in the dollar for a year. It was firmer than it would have been.
It was, but the world was a different place then. You know, we don't have the crises that we have now, so to speak. We don't have the meltdown in the export markets and global demand. The world was still ticking along quite nicely on the growth front when this was enacted in the United States, and the world's a very different place at this time.
I'm going to ask you, why do you like the yen?
I thought because of all the money that was going to be coming back, because the carry trade is unwinding. There is a gigantic carry trade. It's going to continue to unwind, I think, and then there's all that money the Japanese are going to bring back. Okay. Japan has horrible problems down the road.
Absolutely.
I'm talking about just for a while, but maybe, Jeff, I'll go home and sell my yen.
Okay.
Buy some dollars.
Talking about selling, Jim, you're holding U.S. dollars, holding U.S. equities, but you've been quoted saying that sometime this year you're going to get out of whatever dollars you still own and also whatever U.S. equities you still own. The dollar position, when you get out of all of that, is that going to be when you think dollar is peaked, or?
It's going to be when I think it's peaked. You think I'm going to get the timing right? Absolutely not. I guarantee you I will not get the top under no circumstance. Right. Yeah, Martin, I'm even selling my U.S. life insurance policies. If I die, I don't want my estate to get U.S. dollars. Yeah. So I'm getting out of in serious trouble down the road. Not for a while.
Okay, how far down the road? And doomed? Why? Because of the twin deficits, or?
Well, I can't imagine that going forward with the quantitative easing and the deficits and the sheer amount of debt that the U.S. government will have to issue, et cetera, in 2010, 2011, that won't feed through to a weaker dollar at some stage.
Martin, the numbers are staggering, just unbelievable. You can't even add that high. They're so staggering, and they don't even care in Washington. They're trying to get through the next election.
But the whole thing is, they're printing money like it's going out of style. It's going to lead to, at some stage, higher prices, inflation, and that is going to ultimately benefit commodities, right?
Buy yourself some gold.
You brought the coin back.
I think I'm going to make more money in other assets. When I was in there a minute ago getting my coffee, I got my sugar too. So I got my CNBC sugar. So I'm covering all the bases.
Soft and
There's my
You like gold, you like sugar. All right, understood.